Hey guys, it's Chris Wong here. I decided to do a fictional scenario presentation. So nothing about this portfolio is real, and I decided to come up with a situation of winning the lottery and deciding to invest the money. And I just picked a net pay of $5 million to invest. So I came up with steps of what I would do if I actually did win the lottery. To be realistic, if I actually did win the lottery myself, I would not be sharing it on YouTube and I would keep it to myself. So the number one thing I would do is keep my guard up at all times. Because what happens is if people found out you win money or you came across a large inheritance, people will start talking to you more, and it may be for their own benefit. So it's not to benefit yourself. Businesses may start approaching you because they know you have money to spend. So I think low profile is very important. I wouldn't want to make myself public saying that I came across a large inheritance. Like, I don't mind talking about fictional portfolios, and I don't mind talking about what I would invest in myself. But when it comes to the actual wealth or the real wealth, I keep that private for myself. And the one thing I would do is before you do anything with the money is make sure all debts are paid off, including houses and cars. So I don't want to do anything myself until all debts are paid off. Because once all debts are paid off, you're free. You can actually don't have to worry about paying off your interest or owing people money. It's also easier to invest when you don't have any debt to pay off. And if I actually did win, I would actually call in sick for a day or two off work first. Because if you do win, you'll be excited. And it'll be hard to keep that excitement for yourself if you go to work. So I would recommend just call in sick for a day or two and just relax for the day. This is the most important point to me if I actually did win, if I still hold a job. And that is, don't quit your job. I would rather still go to work and until I can find purpose for myself. And if I actually did like the job, I would still continue working. Even if I work less hours, I would consider doing that myself. Now, once I have my guards up and everything mentally prepared, I would actually improve my intelligence on finances. I would make sure I become smarter with money, more control. There's nothing wrong with getting a financial planner or an advisor or getting an accountant to help you. But the most important thing is actually becoming aware of what's going on. What you don't want is have your money trusted to the accountant and then not know what's happening to your money for years. Because the worst thing can happen is your accountant didn't keep up with all payments, or your financial advisor gave you bad investment advice that actually cost you more money. It's also important to invest. And I think investing is what's going to keep your wealth. Investing is going to make you even wealthier. Investing will help you live the lifestyle you desire. And when you start investing, I would say it's important to diversify your funds. It's important to have multiple brokerage accounts and multiple bank accounts. You never know what's going to happen. And you could have a day where the one brokerage account, you cannot access it because maintenance, or your account gets hacked. So I would say it's important. Don't put your money in one basket. And it's important to have multiple, have backups. Once everything's in place, now you can become more generous and celebrate. And the reason why I say that is because the way of investing, this style, passive income investing for monthly dividends, is that you're expecting dividends every single month. And as long as the funds will last, you keep getting dividends every single month. And you won't run out of money as long as you don't sell your funds, as long as you spend less than your dividends. So now onto the fictional portfolio. So before I start talking about the breakdown of the charts, I am a Canadian investor and I live in Canada. So I actually base all the investments on Canadian funds in this scenario. I also made the assumption that all the investments are done through a non-registered account. So I did not take into consideration in this scenario for TFSA or RRSP. I also did not factor in taxes into the calculation of this. So this is just showing the dividends. The taxes, assuming you live in Canada, will be filed at the end when you do your tax return. So let's just get to the charts, and I'll start off with the low risk chart. So the low risk chart I have is based on preserving your original capital investments. So something like cash, HISA, and PSA. If you time it correctly, you can buy them all at $50 per share. And then when they do rise up in price, they rise up based on the interest rate that it generally is going to pay out. So then from the ex-dividend date to right before the next ex-dividend date, there's a slight increase over time. And then once ex-dividend date hits, it goes back down to $50. And then a few days later, it pays out the actual dividend for the month. So it is a way to put some money aside. And I've done this myself before, where I would have some as cash, HISA, or PSA. And then when I saw an opportunity, when something dropped, then I would sell these ones and I would buy the stocks that I found that were a bit undervalued. SPLT is like it's by Brompton Group, and it's based on the split funds of other corporations. So I found their goal is to maintain the capital, even though the stock price does vary a bit, but it usually varies between, say, like 10.10 and 10.40 of what I've seen. I just picked 10.37 in this case, and I just based it on dividend history. So what I saw here is that the total investment is over $800,000. So just assume in this scenario, the person who wins $5 million wants to keep at least $800,000 into much safer investments. So even then, the dividend per month is over $4,000. And the annual dividend is over $48,000. So for the next chart, I decided to do banking. And I picked about 6 different ETFs or funds that cover banking. And they're all listed on the TSX. So the stock symbol bank and call are by Evolve ETFs. Bank is based more on Canadian banking, and call is based on US banking. Now you can see here that the yield for bank and call is pretty high. And it's one of the reasons why I picked those funds. And then I also pick a BKCL, which is a leveraged version of BKCC by Horizons ETFs. And it's also a really high yield one. And then I also pick HMAX, which is by Hamilton, ZWK, which is by BMO, and SBC, which is more of a split fund instead of ETF, and it's by Brompton. I picked random numbers, and I based on the average book price on my own numbers that I had on my own personal chart, and then decided to play around with the number of shares to see what it's like for someone to invest in banking with a total portfolio of $5 million. But I decided to just make it smaller in the situation, as I do believe in having a bigger portion in a more all-in-one type sector. So I decided to limit the total investment to, say, $264,000. And then what you see here is that even with $264,000, the dividend per month is still over $3,000, and the annual dividend is over $37,000. So for the next scenario, I picked energy and utilities as a category. And I think energy and utilities are always going to be important because we need energy and utilities to live our lives these days. So I decided to pick mostly funds that actually have multiple companies within each fund. As in the rare case, if one company goes out of business, then if that company is within that fund, so the fund gets affected a little bit, but then whoever manages the fund can just change the holdings. So I decided to pick ENCL, which is a leveraged version of ENCC, and it's run by a Horizons ETF. And then I pick ENS, which is based on Enbridge, and Middlefield manages this fund. And I also picked HUTE, which is Harvest Utilities, and it's a leveraged version of HUTL. And then I also picked UMAX, which is a yield maximizer type fund by Hamilton ETFs, and it has pretty high yield. So I decided to actually just play around with random numbers, and then for ENS I actually put a smaller amount compared to the rest of them because ENS was only based on Enbridge only, and I'm sure last time I checked ENCL or ENCC, Enbridge was one of their holdings. So as you can see in this chart, the total I just put in is only about 242,910, and then the monthly dividend is close to 3,000, and the annual dividend is close to 36,000. So still a good amount of dividends to live off of. So the next thing I decided to cover is real estate. And I actually did pick a bigger amount for real estate, like more than I thought, as I think real estate is going to be important no matter what, as people are going to be interested in buying houses or renting property, whether it's for living in the house or it's for commercial use. But me personally, I'm not really interested in physical real estate. So it is a way to get like monthly dividends through investing through ETFs or split funds. So I'm looking at $703,000 as a total for 3 different funds. And the ones I pick are HGR, MREL, and RS. So HGR, it's a real estate ETF from Harvest. And I just decided to have an interest in real estate, so I decided to just pick it anyways, even though the yield is a bit less compared to the ones I picked are mostly 10%. And I also picked MREL and RS, which are both managed by Middlefield. And MREL is an ETF version, and RS is more the split fund version. And the yields are a bit different for both of them, so they have different risks based on how the funds operate. But within these real estate funds, they have multiple real estate companies within them. So at least I'm not limiting myself to just one real estate company or fund. So I think that's where diversity comes in. And if I were to get into real estate myself, like there's a lot more work with the physical real estate of housing. So this is one way I found investing in real estate is a way to make money off your investment without actually doing any physical work or worrying about tenants, as the funds or the funds within the funds can take care of that. So you can see here in the scenario, with over a $700,000 investment, the monthly dividend is like $5,565, and the annual dividend is over $66,000. So for the next chart, it's actually the biggest investment. And even in my real portfolio, I actually put a higher percentage of my money into these funds. So I decided in this scenario to put a total of, say, half the investment into all-in-one type or index-based funds, because the all-in-one types cover all sectors. So some of these are ETFs of other funds. So something like HYLD, their main holdings are other ETFs. And then within the ETFs are other companies. So it covers many different things. And the index-based ones are based on the S&P 500, NASDAQ 100, or even TSX 60. So it covers pretty much all companies around Canada and US. So for example, QQCL covers the NASDAQ 100, and ESPX covers the S&P 500. So you can see here, I put each of these investments, most of them over 100,000, and even something like HYLD over $400,000. So you can see here, the dividend payouts are really big. So even with $2.5 million total investment, I can see here the monthly dividend is over $24,000 and the annual dividend is over $289,000. So still a lot to live off of. And I even decided to put ZEQT, which is a BMO all-in-one type fund. Now the yield of this one is lower, but I decided to put it in anyways, as I think diversity is important. And with someone who has a lottery winning of $5 million, why not invest more into like some lower funds as well? So I know passive income investing likes high yield funds, and I generally prefer high yield funds as well. But I know this yield here is like 6%. But 6% yield is still decent. So for the next chart, I decided to pick technology and healthcare. Healthcare is going to be important regardless because people rely on healthcare to survive. And we're always going to need doctors, and we're always going to need medical technology. So that's why I put some money into HHLE, which is the leveraged version of HHL, and it's by Harvest. And then I also pick HTAE, which is the Harvest Tech Achievers leverage version of the fund called HTA. And then I just pick QQQY by Evolve. I know there's QQQY by Defiance Funds, but in this scenario, I decided to use only the TSX Canadian listed funds. And even though QQQY Evolve is supposed to cover the NASDAQ, but I just decided to put in this category because they only picked, I think it was about 40 or 41 technology companies. And I also put like smaller amounts in them. So because of this sector, I didn't seem to focus on it when I did the calculation. So I didn't seem to get a higher amount and ended up lower than I expected. But in the future, or let's say in any hypothetical situation, I can play around these numbers. So somehow I just ended up with a total of $240,000 invested. But it's still a good, decent monthly dividend of $2,085 with an annual dividend of $25,000. So for the next category, it's the other. So I didn't know where to group these funds, and I didn't want to make like 3 separate charts. So I decided to just put the last 3 funds into other. So GDV, HPYT, and PDIV. GDV is a split fund by the Brompton Group. Same fund manager as the ticker symbol BMAX, but they run differently in terms of how the investment works. So GDV, I believe it has some international exposure, and also because the way the fund works, I decided to just put less money in. Now some people I think will put even more money into them, but based on how I was splitting the money, I didn't seem to have enough, or didn't want to play around too much, so I left it at say $20,000 for a total investment. HPYT is it's a Harvest bond ETF which I think is based on the TLT bond ETF by iShares. And because of the high yield, I decided to put a little bit more, but because it's based only on bonds, I left it at around 35,000 in this scenario. Not to say that the ETF is risky or not, I just, because it doesn't cover all in one type, so I put less money into them. Also, HPYT is one of the holdings of the ticker symbol HDIF. So it could be one reason why I decided to leave it at 35,000. And then PDIV is by Purpose Investments, which this one, I don't remember exactly what it covers, but I just like the high yield, and it covers multiple companies. And because it's ETF based, so I'm not too concerned about dividends not paying out, because I believe ETFs, they're not going to skip monthly dividend payouts. So I have here for a total of 164,000 for these three funds, which still gives a good dividend, a monthly payment of 1,695. So this is a summary chart of all the previous charts, just showing the totals of like the total investment, the dividend per month, and the annual dividend. And I even had the percentage of the portfolio added up. So at the bottom here, you can see this is 100% of the investment for the total. And you can see here, if someone actually won a lottery of $5 million and decided to go all in using passive income investing. And passive income investing is a method I picked up from watching Adrian's channel. And he has really good content. So in this scenario, you invest all $5 million, you get over $500,000 in your annual dividend. And your monthly dividend is over or close to $44,000. So it's still a lot of money to live off of. So this is why I think investing is very important. Like, you could win the lottery and you could retire, but you have to know what to do with the money in order to keep your wealth. Because if you, say, won the lottery of $5 million and decided not to invest it, you can actually eventually run out of money. And even if you try to live off the interest rate of $5 million, you're still taxed on it a lot. And eventually, trying to spend or try to be as cheap as possible, you're eventually going to run out of money because everything is going up in price. So having a $5 million winning as of today is not going to be the same $5 million value if you, say, won the lottery, say 10 years later, 20 years later. So that's why investing is very important, especially if you're a type of person who wants to retire, who wants to be more generous, who wants to live life. I hope this gives you guys information on what investing looks like at a $5 million portfolio compared to whatever portfolio you guys have, whether it's $1,000, $10,000, $50,000. At least it gives you an insight on what a lottery winner could do with their money if they actually won $5 million and decide to invest it this way. If you liked the video, please give me a thumbs up. If you want to listen to any more of my content, please subscribe to my channel. And thank you guys for listening.